The central bank bubble's bursting. It will be ugly. The global economy has been living through a period of central bank insanity, thanks to a little understood expansion strategy known as quantitative easing, which has destroyed Main Street and benefited Wall Street. Central banks over the last decade simply created credit out of thin air. Snap a finger and credit magically appears. Only central banks can perform this type of credit magic. It's called printing money, and they have gone on the record saying they are magic people. Increasing the money supply lowers interest rates, which makes it easier for banks to offer loans. Easy loans allow businesses to expand and provides consumers with more credit to buy goods and increase their debt. As a country's debt increases, its currency eventually debases, and the world is currently at historic global debt levels. Simply put, the world's central banks are playing a game of monopoly. With securities being bought by a currency that is backed by debt rather than actual value, we have recently seen $9.7 trillion in bonds with a negative yield. At maturity, the bondholders will actually lose money, thanks to the global central bank strategies. The Federal Reserve has already hinted that negative interest rates will be coming in the next recession. These massive bond purchases have kept volatility relatively stable, but that can change very quickly. High inflation is becoming a real possibility. China, which is planning to dethrone the dollar by backing the yuan with gold, may survive the coming central bank's bubble. Many other countries will be left scrambling. Some central banks are attempting to turn the current expansion policies around. Both the Federal Reserve, the Bank of Canada, and the Bank of England have plans to hike interest rates. The European Central Bank is planning to reduce its purchases of bonds. Is this too little, too late? The recent global populist movement is likely to fuel government spending and higher taxes as our protectionist policies increase. The call to end wealth inequality may send the value of overloaded bonds crashing in value. The question is, how can an artificially stimulated economic boom last in debtors' economy? Central bankers began to embrace their quantitative easing strategies as a remedy to the 2007 economic slump. Instead of focusing on regulatory policies, central bankers became the rescuers of last resort as they snapped up government bonds, mortgage securities, and corporate bonds. For the first time, regulatory agencies became the world's largest investment group. The strategy served as a temporary band-aid as countries slowly recovered from global recession. The actual result, however, has been a tremendous distortion of asset valuation as interest rates remain low, allowing banks to continue a debt-backed lending spree. It's a monopoly game on steroids. The results of the central bank's intervention were mixed. While a small, elite, wealthy segment was purchasing assets, the rest of the population felt the widening income gap as wage increases failed to meet expectations and the cost of consumer goods kept on rising. The policies of the Federal Reserve were not having the desired effect. While the Federal Reserve Bank began to reverse its quantitative easing policy, other central banks such as the European Central Bank, the Swiss National Bank, and the European National Bank have become even more aggressive in the quantitative easing strategies by continuing to print money with abandon. By 2017, the Bank of Japan was the owner of 3/4 of Japan's exchange-traded funds, becoming the major shareholder trading in the Nikkei 225 index. The Swiss National Bank is expanding in quantitative easing policy by including international investments. It is now one of Apple's major shareholders with a $2.8 billion investment in the company. Central banks have become the world's largest investors, mostly with printed money. This is inflating global asset prices at an unprecedented rate. Negative bond yields are just one consequence of this financial distortion. While the Federal Reserve is reducing its investment purchases, other global banks are keeping a watchful eye on the results. Distorted interest rates will hit investors hard, especially those who have sought out riskier and higher yields as a consequence of quantitative easing. The policies of the central banks were unsustainable from the very start. The stakes in their monopoly game are rising as they are attempting to rectify their negative yield bond purchasing with purchases of stocks. This is keeping the game alive for the time being. However, these stocks cannot be sold without crashing the market. Who will end up losers and winners? Middle America certainly isn't going to be happy when the game ends. If central banks continue in their role as stockholders funded by flat currency, it will change the game completely. Ultimate Indicator shows the US never recovered from the 2008 Great Financial Crisis. The ultimate indicator of personal economic confidence is the determination to perpetuate the species and have children. The chart below shows annual US births from 1910 through 2017, and it is estimated there were 3.8 million births in 2017, nearly 100,000 fewer than in 2016. The 2017 figure is also nearly 500,000 fewer than the late 1950s. Baby boom era peak and likewise below the subsequent mid-2000s double peak. The 2017 figure is also nearly 600,000 below the census estimates provided as recently as 2000 and 2008. To offer some perspective, the chart below shows annual births versus total US population. Despite the total population nearly doubling since 1957, the US had 11% fewer children in 2017 than in 1957 or 2007. More poignantly is the US childbearing population, those aged 15 to 45 years old. The red columns represent the annual change, while the blue line is the total 15 to 45-year-old population. As can be plainly seen, the growth of childbearing cohort represented by the baby boom on the left dwarfed the growth represented by millennials on the right. Of course, on a relative basis percent, the millennials represent less than a third the annual quantity of growth than the boomers offered. And millennials' high levels of education, driven indebtedness and poor quality of employment, etc., mean the quality of growth they represent is even lower than their numbers would indicate. A last note regarding millennials: their estimated growth was never organic, as births essentially never exceeded those during the boomer period, and instead was almost entirely dependent on estimates of continued high rates of immigration. The same immigration that has dramatically slowed since the early 2000s. The chart shows the sources of 15 to 64-year-old population growth, declining births versus immigration, annual average per 5-year period since 1970. Given this, there is a high probability that the size of the millennials significantly undershoots estimates. Births continue to decline since 2007, represented by columns in the graph below, while the census birth estimates continue to tumble. Lines below represent select census estimates from 2000 through 2017. The census estimates for 00 and 08, essentially identical. Anticipated annual births would rise to 5.7 million by 2050 and continue rising thereafter. However, after the 09 GFC and 10 decimal census, the Census Bureau began dramatically reducing their present and future estimates for growth. Nevertheless, each reduction was still far too optimistic. Total births continued to surprise to the downside, and significantly lower estimates are needed if the census forecasts are going to match reality. I offer a more realistic guesstimate, dark blue line, based on the ongoing changes to the childbearing population and current trends. Even immigrants quickly norm to the lower fertility rates once in the nation. Simply put, the conditions for family formation and child rearing continues to deteriorate. The US isn't alone.